Wall Street is trying to game out the impact that tariffs might have on markets. Morgan Stanley's chief U.S. strategist Mike Wilson believes the tariffs are a starting point for negotiations rather than a, quote, clearing event. I'm thrilled to say that he joins us now at the desk. Mike Wilson, how are you?
I'm doing great. How are you?
So you wrote that on Monday,
yeah,
I believe. Is that still the case? Because we heard from Donald Trump yesterday saying that these most recent tariffs, specifically the auto tariffs, are permanent and that he's not interested in negotiating any exceptions.
Well, one thing we know about the president is he changes his mind back. I mean, this is a negotiating tool. The question is, how far do they have to go to get what they want? And the other question is, what do they want? So It's, like I said, it's the beginning of learning. We're going to learn more next week, and then we're going to learn more kind of as we go through this back and forth process. And how much do countries engage? We've seen a difference there too. Like Mexico seems to be engaging, Canada not so much. So this is going to be, volleying back and forth. But, I want to go back to our call for this year. Like, we were not that focused on tariffs because there were so many other things that were probably going to be a headwind for growth. And so even if this gets resolved, some of those other headwinds really don't go away probably until the second half of the year. And that's something just to keep in the back of your mind.
What do you mean headwinds? Don't you still think the market's going to go up like 800 points by year end?
They could. I mean, we have a 12-month target of 6,500. I mean, I still stand by that. But that assumes that we can get to the good stuff of the policy by the end of the year. Now, maybe that 6,500 gets pushed out a quarter or so.
But that's your base case, right?
Correct.
So you do assume that we're going to get to the good stuff.
I think we are. I mean, look, and I think we've been right about this, which is I think people came in too excited that, oh my God, we got all this, pro-growth strategies, but that really isn't possible given the output gap. And that's what's very different about this term versus the president's first term. When he came in the first time, we had all this slack in the economy. And this time that wasn't available. So I think they're actually doing it the right way. The sequencing is, let's do the growth negative stuff first, and we can go through all those. And then the good stuff like deregulation, lower taxes, maybe we get term premium to come down because the budget deficit looks a little bit more attractive. That's going to take time. And I think, it's interesting to watch. I mean, first of all, Treasury Secretary Bessent and then the president himself have really sort of confirmed that thesis. Every time they speak, they kind of talk to this idea that we're gonna have a tough 6 or 9 months, maybe 12 months.
Detox period.
100%, and that's a tough message for investors who've become addicted to policy.
So let's for a moment think about what happens if we don't hit that base case. So what are the headwinds that you see around the corner that are not related to the tariffs?
Yeah. Well, I think they're all related. So, I mean, not related would be that everything conspires together and it gets away from them. Like, I don't think the administration wants a recession. They want to slow things down, and then maybe they want to affect a recession in government. Okay. The question is that going to spill over into a recession in the private economy in a way where it's much worse? And in that scenario, then we're going to go lower than our 5,500 kind of first half downside target. Okay, we're not there yet. Like, our economists have cut their estimates, but they're not in the hard landing camp. Another thing I just want to bring up is, a term that we sort of invented 5 or 8 years ago was this rolling recession, right? We've had another one of these rolling.
You're in a battle with Ed Yardeni now.
Yeah, well,
I thought that was his.
We could check the tape on that. But let's go back to the original rolling recession in 2018. But anyways, my point is that we've had another one of these rolling recessions. Okay, so why aren't we going to have a rolling recovery? In other words, as Scott Bessent has said, and we've been making this case for 2 years now, most of the private economy has been in a recession for 2 or 3 years. So what are we talking about? Like, in other words, if the government goes into a recession, slow down negative growth, okay, does that mean that housing is going to become worse in the GFC? Because right now we're selling a number of homes that we were selling in 2012. I mean, that's kind of a recession. Okay, same thing for manufacturing, same thing for consumer goods. Call that we've been, underweight consumer goods for literally 3 years, and it's paid every year. Small cap stocks, it's paid every year to be underweight these areas. So the market gets the joke. I just think a lot of stock observers haven't really understood what's been going on here. The economy has not been strong. Okay,
right.
It has not been a balanced, good economy. It's been a very unbalanced economy. Strong government. Okay, strong services because a lot of rich people are making money off the stock market, and then you have this AI capex sort of driver.
Right.
But beyond those 3 areas, I mean, please tell me, where is the strength in the U.S. economy? Where has it been?
Yeah, no, it's a good question. And you think about the rolling recession, and you mentioned the AI capex story that really papered over a lot of the ills that maybe you saw if you looked closely at this economy. So if the play during the rolling recession was to just buy the indexes, bet on big tech. How do you play a potential rolling recovery? What sort of nuances do you look for there?
Yeah, so we're starting to do that work now. We've been doing that work. I mean, clearly, if you have a true hard landing, okay, the day that it becomes consensus, the first thing you want to do is buy the lowest quality stuff in the market. So consumer goods, right? You want to buy beaten up, really levered companies, bad balance sheet type businesses, maybe material stocks, energy stocks, the stuff that is really languished, that needs economic growth to kind of reset and then have a reflexive move higher. So in 2020 and 21, I think we were fairly out of consensus on this idea that we were going to have this huge operating leverage story coming out of the recession and the V-shaped recovery, and that was going to lead to this incredible earnings story. That's when you had a very broad stock market, right? When inflation is actually accelerating and you have pricing power. Today it's the exact opposite. Companies don't have pricing power. They can't really pass this on. So we've had a margin squeeze really in a lot of industries for the last couple of years, except for if you're a monopoly, okay, these large tech businesses or other businesses with scale. And they've been able to kind of manage this, the operational efficiency, the managing their costs and passing on price where they can. And so that market is still very much intact. So our core portfolio is still quality defensives and quality growth. And that's going to continue to work until one of two things happens. Either growth accelerates exogenously, like there's a new driver of growth, or we have a hard landing.